Hey everyone, and welcome to the latest edition of Capita's LinkedIn Live. And I'm joined here by a good friend of ours, Anshuman Sinha, who's a co-founder of Startup Steroid and a prominent angel investor. Anshuman, really good to see you, and thanks for making some time for a chat.
Yeah, hi Amit. Thank you so much for having me on this show. I sit along in a lot of pitching events and look at the startups for investment.
Yeah.
I just recently concluded my trip to India. It was a 21-day trip. I visited about 6 to 8 places, and
Mm.
everywhere I met with the startup founders. So I personally have a lot of questions on cap table because early stage startups, I feel they are still not fully aware of what is the importance of a cap table before they go to angel investors. So I'm looking forward to this chat.
No, absolutely. And look, I think that's probably the nature of a startup world. We're all trying to figure it out. None of us know full answers, but that's the beauty of it. So hopefully today's chat about sort of cap tables will help a few people out, and we appreciate everyone tuning in. As with all the LinkedIn Lives, we'll have a pretty casual chat covering various topics that we think might be of interest. But if you have a question in mind you would love to learn more about it, just drop it in the comment section. We'll be able to see it, and we'll try to address as many questions as possible while we're live. Ultimately, whatever we don't cover as part of the next 25 30 minutes, we can definitely more than happy to arrange a follow-up discussion in private. So don't be shy to reach out to either one of us. Look, Achuman, I kind of want to just kick off the conversation. So I don't know, you mentioned you have a few questions you kind of want to, or topics you want to cover. But from your experience, you already gave us a pretty good introduction. You've come across a lot of queries. You work with a lot of founders as well. But I want to pick on that comment you made about your recent trip, because you're obviously based in California in the United States, but you obviously operate quite actively in the Indian ecosystem as well. How do you kind of compare them, and especially what are the trends you're sort of seeing on both sides of the world that you find most interesting from your recent travels and discussions with various founders?
Sure, Amit. So one thing which is quite evident and apparent is the US-based companies are much more mature at a very, very early stage. The founders, they have done their research, they are fully prepared to be in front of angel investors. And this is a direct experience that I had in meeting with over 100 startup founders back in India. And I want to help them, along with you, Amit, and Capita,
Yeah.
and all the companies that we run. We would like to help mentor startups because, for example, I met with a startup in Delhi uh, who had diluted 22% to hire somebody as the sales guy, given
Mm.
him the title of a co-founder, raising fund at $20 million valuation, and without taking any investment from this co-founder, given him 22%
Right.
stake.
Right.
So that certainly tells me that he has no knowledge of the cap table, and when he goes in the market, 22% of $22 million valuation. So think
Mm.
of the number of shares and
Yeah.
the equity that he has already diluted just to have somebody fully on board, because he can't afford that resource on a full-time salary basis. But the way he diluted himself does not equate to the full-time salary he could have given him if he had the money.
Yeah,
So there's
absolutely.
a lot of questions like that. And, I had discussed that with a lot of startup founders who are in early stages of their funding round. They have already raised their friends and family, and now they're ready for angel, but they don't have a cap table. So I
Right.
think there is a big gap. So my first question to you, Amit, is when should a startup founder set up their cap table, and how difficult or easy process is it with capital?
Yeah, no, for sure. And I think it's important to probably start with what a cap table is in the first place. I think we hear that word pretty frequently, but maybe not everyone in the audience has a pretty good grasp of what it is. So what a cap table is a register and represents the ownership of a company's business. So for you as a founder with your co-founders, you want to see exactly who owns which piece of the company and how much they own. And as you can appreciate, and you sort of alluded to, it can get pretty complex, right? And it's easy to make mistakes or not really take it seriously early on, and that can cause some trouble down the track. And especially in private markets, when you're going to be raising capital from friends and family, angels, syndicates, VCs, later on maybe even PEs. The fundraising can come in many shapes and forms, and the capital structure of the business can get quite messy because you may be utilizing various instruments. You have your common stock, you have your convertible instruments, safe notes become quite popular as well. What does it all mean, and what does it mean for your business as a founder? So it's very important for any founder to have a really good grasp of the ownership of their business, and that really starts with understanding the cap table. And while cap table technically is a representation of ownership in the business at the moment, so for that reason, it's never too early to start thinking about it and start planning ahead. So we definitely want to encourage everyone to start considering and understanding what the future holds as early as possible from the early stages. And as you go through each fundraise as well, your capital can be a good foundation, the basis for you to also understand dilution, understand what the future holds. Because what any founder can do is once you organize your capital in any shape or form, you can use it as a basis to model what the future holds. So every time you get a VC term sheet, right, you can understand exactly what it means for you. What does it mean for you, for your co-founders, what it means for your employees? So I just want to give a really good example of sometimes it's easy to make a incorrect call that can, for example, make it trickier for you to raise capital down the track as well. So if you give away too much of your company, or if you give a small piece to too many investors potentially, there's many different ways your capital could get quite messy and out of hand early on, and it could make it a lot more trickier to not only fundraise, but even potentially cause some trouble down the track and exit environments.
Mhm.
Yeah, so there's definitely a few things to do. And what we encourage you is you can think of it as like, cap table is a premise, as a foundation of investor relations. And it's important to build those good habits early. So we definitely encourage everyone to understand, educate themselves. So that way, whenever you have discussions, not only with your existing investors, your co-founders, but even potential investors, you know exactly the structure of a current business, so what do what you yourself getting yourself into. And sometimes it's a matter of reaching out for help and asking those around you, those who have been in your shoes and have raised capital before, is what to look out for. And thankfully there's a lot of good materials in the public domain that's available that everyone can find. And obviously organizations like ours that assist founders through that process well from day one.
Yeah. So Amit, to simplify it for the first time founders,
Hmm.
it is a list of anything that you have done in your company, including the equity share, preferred share,
Sure.
options, warrants, convertible note, debt, anything that you have done in your company. It is a list of that and how it equates to 100% of the ownership, correct?
That's exactly right. And when you look at it, there's actually two ways to look at it. You can look at it in the current state, which means what instruments, what shares, securities have been issued, right? But what is equally an important view is on a fully diluted basis, right? Because in a lot of early stage companies, it's very popular to raise, YC safe notes, right, or any other convertible instruments. And what it effectively means is that you receive capital infusion to your business now, but you don't necessarily issue shares on day one. There's usually certain triggers, potential next price round, when another investor comes in and prices the company. At that stage, those notes convert into a underlying security class. So it's very important to understand not just who holds what at the moment or which shares have been issued, but what's the potential additional dilution may happen. What we're seeing more recently is with the popularity of safe notes, you may be raising multiple safe rounds as well. So how did they all interact? What does it all mean? Because as I mentioned, I'm sounding like a bit of a broken record, but it can get out of hand. It can get quite messy. So it's very important to get a good grasp on not only what the cap table looks like now, but exactly what it means for you, and what that 100% at the moment what's been issued, how does it translate to 100% on a fully diluted basis? Also considering options you may have given away to your employees through an ESOP or any other equity instruments. Yeah, so that's all very important.
So cap table and the ESOP table, those are two different documents, or it is part of the same table? How
So,
does
so
that work?
yeah, so look, when you look at cap table equity management, a lot of times it refers to the entire ownership, right? And for you as a founder, whenever you log in, it's very to a system like capital or look at the ownership overall. It's important to consider both the investor side and the employee side. By important aspect, even though there are two technically different audiences, they're quite interlinked. So usually what happens if you want to give away equity to your employees through an option plan, which is quite popular, but can be done in many other different ways, you usually carve out a percentage of your company that's called employee pool, and that effectively acts as your savings account of the shares that can be issued in the future time to satisfy your obligation to deliver shares to your employees. So what usually happens, let's say in early days, you may create a 10% pool. What it means is that you dilute yourself and your co-founder by 10%. That percent sits there, and that can be utilized to give away options to your employees. So, for example, in that example you gave earlier with the a sales hire, potentially in that instance, it may have been wiser to utilize a pool and give away maybe a cash compensation plus a little bit of options to incentivize that early hire, rather than giving away straight up equity to them. So as you can see, these two aspects are interlinked. And even though your ESOP or option plan or stock program you create will be governed by a certain set of rules, which is just going to be a plan rules of scheme document, they're very closely linked to your capital. Because whenever you give options to employees, the underlying security into which those options convert when they're exercised in future will likely going to be common stock in most cases. So as you can imagine, if you give your first couple employees some options, they are not necessarily shareholders on day one, right? They're not receiving share certificates immediately. However, they receive a derivative instrument, an option that can be converted into those underlying shares in future. So for that reason, as you can, hopefully we're painting a clearer picture now, is that dilution is a very important concept, and it can, come into play in very different stages of the company, both from the investor side as well as employee side. So, Ajman, I want to flip it back to you because in your time, you obviously work with many, many different organizations as well. So, what are sort of the common, I guess, missteps you see with cap tables? Any common mistakes you see more frequently than not, and you wish founders could avoid as much as possible?
Yeah, so the biggest thing that we see on a very regular basis when we are doing the deep dive and the due diligence is that the cap table is not fully updated.
Mm,
So I would like to hear from you that how frequently the founder should go and look at their cap table and keep updating it, and how difficult or easy it is on Capita.
mm,
Another thing that we see that misclassifying or misunderstanding the different type of securities, that happens a lot because
sure.
you look at options, you look at equity, you look at ESOP, so many things, convertible note,
Yeah.
but have they really been categorized in the right way, overlooking the impact of equity dilution also
Yeah.
to the existing shareholder. Many a times for smaller companies who are in early stages of their angel round, I have seen that they have cut a side deal with one of the previous friends and family or whoever, that hey, in second round you're not going to dilute. Making that statement is so much easier, but capturing that moment and putting into a cap table becomes so much more difficult. And you just cannot pick and choose,
Mm,
because of the SEC regulations that we have over here.
correct.
uh, Similarly, not clearly documenting the terms of the stock options. That has, it is easy. You are working with your CPA, you are working with your attorney. They tell you, okay, this is the cliff and this is the vesting period. But does the founder really understand those terms? And another thing, question to you, Amit, is that do you have documentation on that where the startup founders can go and study and try to learn? Do you have informative videos out there on Capita where the first time founders, once you have gone through the process, you are the second time founder, many things are much more clearer to you.
Yeah.
But how we can help the first time founders?
No, definitely. And you've touched on a couple points. I'll try to address them all. Is definitely as you go through it, cap table is not going to be something you're going to be looking at every day. However, when the time comes, especially during fundraise, it becomes very critical and important. And usually, fund you'll have many different other priorities. So it's very important to sort of get it right early, because ultimately your cap table acts as your single source of truth. Right? This is something that will be looked at as part of due diligence, as part of your fundraise process, and also for yourself. The examples that we were given earlier is that when you receive a term sheet, you want to understand what it means for you. You want to comparing term sheet A and B and understand exactly what dilution looks like, what the number of shares will be issued, and what does it mean for me, my co-founder, and every other investors. It's very important. So even though it's not something to be refreshing every day, every time you start your day, it's very important to get it right done early. So for that reason, what we try to do is, on our side, we want to make it a little bit easier for you to set up. And onboarding on Capita, when you load all your cap table and investor records and all the shareholder records, acts as a community due diligence exercise. So what we try to assist founders is kind of navigate through the process, ensure that they understand the capital structure of the business, what all the various instruments are. So if you have a common stock, you have safe notes, you have preferred stock, what does it all mean? How is it set up? So what we do is that all documentation that exists in a company's records are set up on a platform like ours in Capita. We help you understand the entire structure. And what happens after that, once you have the capital structure and all the documents reflected with all the relevant rules, for example, like what's the seniority, what's the liquidation preference of every instrument, then we help you capture every single transaction since inception to date. So what that allows you to actually have is that single source of truth, because you have the entire audit trail of the business from day one, when it was just you and a couple of co-founders, until you have like friends and family in, and maybe a couple angels, and then you're raising your pre-seed at the moment. So anyone who looks in your cap table in the history at any given point in time will be able to see that everything's clear, organized, reconciled, adds up, and all makes sense as well. And then for you, you equip yourself with all the key information to ensure you have a clear understanding, the picture of where your business stands and where it's heading to. And as we were talking about this, Anshuman, we also got a question from one of the audience members, and
Yeah.
asking about how important it is to creating a round and having it the same instrument at the early stage. Is it more important to focus on the investment rather than type of instrument, given there's various conflicts of interest and various parameters comes into play? So the
Yeah.
way I kind of read that question, maybe you can share your thoughts here, is that in our scenario where we're talking about getting yourself organized for the due diligence for the first fundraise, let's say you're raising your pre-seed round and you entertaining, should I raise via safe notes, should I do something else? What's your advice to founders that you interact with? Is it focusing mostly on the messaging, having conversations with investors and focusing on the details after, or is it equally important how the deal is also structured?
Yeah. So thanks for that question, Amit, and thank you, Hari, for asking that question. I think it will benefit a lot of founders out there. I will give you the perspective of what is happening here in Southern California and here in the US. Safe Note became very, very popular, but now it is losing its shine. A lot of money has been raised through Safe Note, but these days, serious investors, serious angel investors like Tech Coast Angel Venture Network, they will not cut you a check if you are trying to raise funds on Safe Note. I personally also feel that Safe Note is still important, but many of these serious investors are not started liking it. So they want to either do convertible note or they want to do straight equity round. So just keep that in mind. Uh, Generally, it depends how big a check somebody is writing. If, for example, if you are trying to raise $300,000 or $500,000, and there is a single check which is coming at 250K, which is 50% of your raise, they will dictate the terms. They will tell you how they are going to invest the money. If you are taking smaller checks, like $10,000 each, my sincere suggestion to you would be don't take them directly on the cap table. Ask them to create a SPV, a special purpose vehicle, and just deal with one manager of that special purpose vehicle. and get that funding round rather than having a $5,000 or a $10,000 investor on your cap table, because in future round it becomes a lot difficult to manage those smaller investor, and then your cap table also looks messy, that why have you been taking smaller checks, that to a tune of $8,000 or $10,000 each. These days there is a process which is called the founder led SPV. It has become very, very popular, and we create that for startup founders, where we call it zero cost SPV to the investor, and the investor loves it because even though they are writing a $10,000 check, they don't want to pay $750 to $850 as management fee for keeping that SPV live for the next 7 to 10 years. So if you are willing to take care of $5,000 to $8,000 of expenses distributed in 7 years, then going through a founder-led SPV is the way, and then take a smaller check. No check is a bad check. If you are in fundraising round, and take as little as $5,000 check, but take them through an SPV will be my recommendation. Safe, again, repeating myself, but if a bigger check size is coming, they will dictate the terms, and try to be flexible at that point of time, because have discussions with your attorney who is guiding you through the SEC rules and all those things. If you are a Indian-based startup and you are looking to raise funds here in the US, make sure your company is registered here in Delaware. Serious investors are not going to invest in you, irrespective of where the product is, where the company is, unless you are based here in US. And it is a very simple process of switch that can be done. So even if you are part of any incubator accelerator in India, have taken government funds from India, still you can switch your company to a Delaware based company for serious US investor to look at you. So SAFE is on the way out. Convertible note and promissory note, and straight up equity is the in thing for serious investor here in the US.
Yeah, for sure. And look, just to add to that, I think it's as someone who looks at a lot of cap tables day in, day out, right? So having too many on yours can be a bit mistake. The fact that you assist organizations with setting up those SPVs is one of the reasons we like working with you, because it actually solves a lot of problems. And just to give everyone in the audience as an example, is that a lot of times you may need to get certain approvals, even signatures from every single shareholder on your cap table for certain matters, right? And you can imagine if you have 50, 100, however many, right, and people go on holidays, they're not reachable. It can actually lead to deals not going through, or major delays, and that's definitely something you want to avoid. So having a cleaner cap table is generally looked at favorably by a lot of investors, and administratively makes your life a little bit easier. Because even though you segregate a lot of smaller checks into a certain vehicle, you may have multiple backers and smaller investors. But from your operational administrative side, you may be dealing with someone who kind of leads that unofficially as well. So it makes your life a little bit easier in getting everything organized. So that's something worth considering. And I think I agree. There's many different ways to build your business and fundraising. Look, everyone's going to give you their opinion. Everyone has their own biases and experience they're coming from as well. But definitely, we're seeing a lot more and more earlier startups that leverage a lot more smaller checks as well. Because a lot of times investors can have value in more than one way, right? It's not just in terms of the capital, but it could be the network or additional support they receive. So for that reason, considering an SPV can be quite helpful for you to keep your cap table clean, and that's definitely something we're seeing as well.
Yeah.
Right. Sorry, you were going to say?
Yeah, Amit, so we are almost coming to our 30-minute mark. One question for you, what is the role of equity dilution play in the cap table? And if you could give your viewpoint on that to founders who are, issuing additional shares. How does that get captured in the cap table? And, what are the pros and cons of doing that?
Yeah, for sure. And look, there's always some initially available data points you can have a look at, sort of benchmark against which each round should be, right? But historically, rule of thumb has been about sort of a 20% as if you go through any sort of a major round as well. So, as your seed level, then you go to Series A. So you do have to dilute yourself to an extent. What you need to consider dilution is not just in terms of fundraising and investor side. Obviously, if you want to raise fresh capital, you'll need to issue additional shares as well. So that's definitely something that you'll have to leverage in the early stages. Dilution, as we alluded to earlier as well, can also come from the employee side. So an important aspect you'll have to consider is creating that initial pool. And that percentage can vary from industry to industry and depending on stage. And it can go from anywhere from like 5 to 15%, right? Having said that, that pool you create for your employees is not set in stone forever, right? And that's something important to keep in mind and strategize about. Because from a lot of the investors, they may want you to create a larger pool initially, because then it's easier for them to manage their dilution in the future. Because they know they can then have a better I guess, predictability in terms of what dilution will look like for their stakes. For you and founder, maybe not in your best interest because depending on your hire needs, how many senior employees or executives you want to go hire in the early days, you may be sitting with this larger pool that's required. So it's a bit of a balancing act as well. Important thing to keep in mind: every time you raise a new round of capital, it's actually possible to top up your employee pool, and that's what we see quite commonly done. So a lot of times you create a smaller pool initially, and as your business grows and your hiring needs and a requirement to hire more senior people to give them more equity increases, you can always top it up as well. So it's very important to have that conversation. So when you consider, to go back to your question, dilution considerations for founders is to educate themselves a little bit, read about it, look at the trends, look at the data, look at a lot of guides available in a public domain or from various providers. Because it's important not to end up in that situation. And I like we keep, picking on that one example you've given to, but sometimes giving away too much equity can really prevent you from being successful in future fundraisers. So it's very important to find the right balance. It's not about giving away as little as possible, right? Because ultimately, the investors who back you, they want to receive something for their capital, and they want to have that upside. So you need to be fair and reasonable to find that right balance. So a lot of times fundraising, there's always going to be a little bit of an element of negotiation. How you structure the deal, and going back to the question for Ari, is like instruments do play an important role because obviously they will translate themselves in how they operate in very different ways. So to summarize equity dilution, very important to understand the current state. Very important to understand all the terms of all the various instruments that have been issued to date and you're considering issuing. So what we do, for example, in Capital, we provide you ability to model, right? You can model future fundraise to see what the dilution looks like, how many shares will need to be issued as well. There's a lot of these kind of tools that help you make better decisions as you progress. So it can be quite helpful because look, when you read the safe note agreements, for some people it's like, oh, this is too technical. I don't really understand what it means. What's a cap, what a floor? So sometimes we're leveraging tools to kind of put it right in front of you on a screen so you know exactly what the numbers look like. They can actually make sense. So don't be afraid to reach out. There's definitely a lot of good advisors and coaches can help you with fundraising as well. Definitely help us out there. And there's definitely a lot of people who've been in your shoes before. So it's wise to use, and learn from mistakes of your predecessors so you can make better decisions as you go ahead with your fundraise.
Yeah, but Amit, tell the founders how they can reach Capita and what is your web address, how they can reach out to you.
Yes, for sure. So for anyone interested getting to know their capital a little better, doing modeling of next funding route and making that process a little bit easier, you can go to www.capita, so it's QAPITA.com, and you'll be able to see our sign up button. So we have an account you can open up and test out to see if that's something you enjoy and like. And definitely, if of interest, you're more than happy to sign up online to start a subscription. We offer friendly terms for early-stage founders to just get their head around it, and we provide support with modeling articles, guides, and video to assist you through that process as well, and obviously, hopefully, make the process a little bit easier for you as you go through the steps. Anshuman, anything you wanted to close off with? So obviously, I appreciate your time, and we're just a bit over the half an hour mark. But any final advice or parting comments for our audience today?
Yeah, the final advice, and I'm going to wear my angel investor hat here, is create your cap table early on. It helps you a lot in understanding your company structure and how much dilution and how you are going to play with the stocks or shares that you have in the company. Capita is a great partner of ours, and we recommend them for using the cap table management. It is easy to use, easy to understand for first-time founders and for repeat founders also. Don't take smaller check in fundraising round. Go and create an SPV. Because as Amit said, that for future round you will have to take acceptance from everyone, and if you have 50 people to get their DocuSign signed, it will take a lot of time, and by then the investor might lose interest.
Yeah.
So keep cap table updated and clean is very, very important for all types of founder. And there is a lot of information out there. Do your research. Go to capita.com to check out their videos and FAQs. And if you have any questions, if you need some more hand holding, reach out to us and we will guide you in the right way. Thank you.
No, I appreciate it. I think that sounds out really well. Thanks very much for your time. It's great chatting with you as always. On that note, I wanted to thank everyone else for tuning in live and those who are going to be checking out this video recording on LinkedIn in days to come. Thanks all for your time. So this was the latest edition of Capita's LinkedIn Live. We usually run these on a weekly basis, covering various topics in relation to equity and everything to do with startups. So keep an eye on the future editions and have a great day. Cheers.
Yeah. Thank you so much, Amit. Bye-bye.